Welcome everyone to our next session in our webinar series. Today we're going to be talking about charitable giving strategies. I'm joined by Chris Mallon and Andrew Randisi, who will walk us through the strategies that we've put together for you today. I'll hand it over to Andrew to get us started.
All right, Chris, let's start with the basics. Okay, so gifts to public charity, anything that would fall into the realm of charitable giving can come under a wide variety of things. It can be giving to a public charity, such as the Red Cross. It can also be setting up a donor advised fund, which we'll talk about a little later in this slide presentation, or any other type of 501c3 organization. Most of the time with giving to charity, it is a tax deduction if you're usually itemizing your deductions. Going over a couple of the basics, what are some of the items that most people could often give to charity? You could give clothes or furniture if it was like giving to Goodwill. But at most, I would say a gift can give cash, which you can get a tax deduction of up to 60% of your AGI, or your adjusted gross income, or as well as for more high net worth for individuals, they may want to give long-term capital gain property in the way of stock. Long-term capital gain property we define as if an investment you've held for greater than 1 year and a day. If you donate long-term capital gain property to a charity, it can be worth up to a 30% of your AGI tax deduction. It's not the end of the world if you give more to charity than in excess of your adjusted gross income in a particular tax year. The IRS allows you to carry up to 5 years of excess contributions to future years.
Can I just, so this is kind of new to me, Andrew, the third bullet point, cash, you can deduct a cash contribution up to 60%. So if my AGI is 100 grand, I can contribute 60 grand and deduct that full 60 grand?
Yes, if you're itemizing.
Yeah, so if you're taking the standard deduction, then you cannot. The standard deductions was an average like 24,500, 25,300, somewhere in there.
As of 2021, we'll look at it for a married couple later in our slides. I believe it was 25,100.
Okay, right. So if say your deductions are not greater than that, then you would just take the standard deduction. So if you're donating quite a bit of money and then you are itemizing, or if you have other deductions, mortgage interest, things like that, then yes, that's when this would come into play.
Okay, great.
All right. One of the common scenarios we see is gifting appreciated non-cash assets instead of cash. So does that mean, typically a lot of times clients will come to us and say, hey, I want to gift, $50,000 to XYZ university. I want to give $50,000 to another, a cause important to them. And then typically say, okay, I need $50,000. So what do we need to sell? How do we get the cash to gift that? Typically we go back to them and say, instead of selling appreciated stock, something that you would have to pay a long-term capital gains tax on, you can simply gift the asset as it is. So in this example here, say you paid $5,000 for, Apple stock many moons ago, and now it's grown to $50,000 in your account, and you want to give $50,000 to charity. So instead of, selling your shares in Apple and having to pay $6,750 to Uncle Sam, and then less money going to the charity than you initially had, desired, you could simply gift the shares as they are, and then you could give the full 50 when end up going to the charity. You wouldn't have to pay any money to Uncle Sam, and you'll get significant savings on your taxes. So this last number here is assuming a income tax rate of the gifter of 24%. So a lot of the times, this is the route that clients typically end up going, because then you don't have to pay less to Uncle Sam, and then you give more to the charity. So say the number is $50,000, no matter what, like a net number. So then in order to get to the 50,000, you would have to give, about 15% more of, you'd have to sell 15% more of something to get that net difference to the charity. So this is a common theme we see, and one that a lot of people end up liking.
Donor advised funds. As I mentioned earlier on our couple slides ago, let's first start with the basics of what a donor advised fund is. Donor advised fund is an account where you can deposit assets for donation to charity over time. The donor gets the tax deduction in the year that the assets are donated. What a great advantage of having this type of account is the donor gets the tax deduction in that same specific tax year. However, they can take as many years as they want to actually gift the assets to the charities that are available through the donor advised fund. The sponsoring organization of which the assets are donated to would be managing the account, and the donor gets to recommend how to invest the assets as well as where to donate them. This is a less expensive alternative to setting up a private foundation, which we'll discuss in a little bit more detail throughout this presentation.
So Andrew, quick question. So how this basically works is I would set up a donor advised fund, right? And then you can jump in if I'm wrong. Send money in, or, stocks, similar to the other example, into the fund. And then you said recommends how to invest the assets. Do we pick, mutual funds, or do the stocks stay as is in there? Is it kind of like a, target allocation type funds? I guess what kind of options are available inside these?
Great question. What I can do is describe the experience that our clients have at Charles Schwab. Charles Schwab has a great donor advised fund accounts set up. The client would donate their stock. For example, we'll take that $50,000 of Apple, for example. It goes in, and what Schwab does into this specialized account, the Apple stock actually gets liquidated. And then from there, the client can pick of a series of pools, of investment pools. They kind of mimic index funds. So you'll have your large cap US index fund, you'll have a balanced fund, they have international, they have a socially responsible fund as well, depending on how the client wants to have those funds invested. And then the client can get access to, when it comes time that they want to donate, it's kind of like a large menu of all the different listed charities that they can pick that charity, select how many dollars. For example, we want to give $5,000 to the Red Cross. We can do that. If we want to give another $5,000 to Drexel University or another college that's near and dear to them, they can do that as well too.
Got it. Cool.
And it's a separate account, right? So it would be, like Andrew Randisi donor advised fund at Schwab. Like it's your own donor advised fund account.
It's your own donor advised account. And the other great thing is if you have children and want to kind of make this a legacy with your kids, you can actually set a beneficiary designation and pass it on down to a beneficiary of your choice, so they can continue in the goodwill of gifting to charity.
Oh, so the donor advised fund then belongs to your child or your heir, and then they continue to contribute to it and decide when to distribute the funds.
Exactly. That gift can continue gift on giving for many generations.
Great. Okay.
Cool. Next up, we've got a charitable bunching tax strategy. This is almost more of a timing technique, more so than, changing the amounts or the vehicles of the gifting. So how this would work is you make a large charitable contribution in your current tax year above your standard deduction. So again, like we talked about before, is $25,100. Say you typically give around, $10,000 a year. This would be good to, kind of front load that. So then the next year you can take the standard deduction. First year you itemize and take, a greater deduction because of the gift in that year. And the next slide goes into more details on the numbers. This can really produce a larger 2-year deduction than 2 separate years of itemized deductions. So it really depends on your income level, tax filing status, and things like that. We'll go into an example here.
Chris, following up from what you were stating in the previous slide, let's kind of look at that example in action of taking the standard deduction versus bunch giving. So with option 1, this is a married this is a married filing jointly couple. In 2020, the couple donated $10,000. They also had $13,000 of other deductions. We'll chalk that up: real estate taxes, mortgage interest, etc. So their total deductions for the year would have been $23,000 for tax purposes. In 2021, it was the same exact thing. The standard deduction in both of those taxable years was higher than itemizing. So the charitable deductions, in effect, they're kind of going to waste for tax purposes because the standard deduction would still be higher. And over the 2 full years, you'd get about $49,900 worth of write-offs. With that bunch gifting strategy, what the couple did instead was the $10,000, instead of doing it over 2 years, they gifted it just in 2020 and gave 20 that year and gave nothing the following year. We still had the $13,000 of other itemized deductions. So in 2020, our itemized deductions were $33,000 and was higher than the standard deduction that year, $24,800. So they itemized in 2020, took the standard deduction the following year in 2021. So the total amount of deductions over the 2-year span was $58,100. So that's an extra $8,200 in tax deductions. Now, depending upon that client's tax bracket, let's just say that was 24%. That's another $2,000+ of taxes saved right there from using this strategy.
Yeah, it can be it's definitely pretty powerful, seeing that it's not any more dollars out of anyone's pockets. Really, just timing. You're not opening up new accounts or anything like that either. It's really just kind of changing when you gift, not necessarily what you gift or how you gift. In that matter.
And it seems like it makes sense if you're going to give, $20,000. Somebody that's going to give $5,000 a year, this wouldn't work for you. Really, you have to be in the
if you're close to that kind of standard deduction versus itemizing, if you're kind of right on the cusp there, where I think a lot of people kind of find themselves, then that's when this would make the most of an impact.
Okay.
Next up, we got qualified charitable distributions from IRAs, otherwise known as QCDs. This is a strategy that comes into play once, especially when RMDs, required minimum distributions, start happening. Once you hit 72, you can start doing it at age 70 and a half. Typically when an individual, so really when this happens is when clients has to start taking their RMD, the amount required by the IRS to come out of your IRAs. And so what this does, an individual can direct up to $100,000 per year to charities tax-free, regardless of itemizing or claiming the standard deduction. So typically how we use this is the RMD comes out of the IRA, you gift the entire RMD amount to the charity, and then you can deduct that, and then you do not have to pay the income taxes you normally would have to pay on that RMD that comes out. Since the RMDs come out, you pay ordinary income tax on that. Instead, you can divert it right to the charity, and then you can basically take that transaction from Uncle Sam off the books. So this also reduces your IRA balance to make your taxable income lower in future years. So it's like a two-pronged approach. You can get the deduction for taking it right to the charity. It also would reduce your RMDs going forward because you are lowering the balance in there, and that's how the IRS calculates your RMD amount, is how large the your retirement account is. It's based off of a factor in there. Make sense? Anything else to add here, Andrew? Anything I missed in this?
I'd say the one thing to add would be if the client does need does need money in excess of the IRA, and when you're kind of coordinating this with the RMD, it's always good to do the QCD first and then take anything out in excess of, because we wouldn't want to have 20,000 come out and then say the client wanted to do, they take 20, their RMD is 100, they
Right.
take $20,000 out, and then they want to do another $100,000 QCD. They're still going to be taxed on that first 20, rather than you would want to do the QCD first.
Gotcha. Okay, that makes sense, because that would satisfy the RMD then.
Yeah, you'd satisfy the RMD first.
Got it. By doing that. Great. All right.
The next strategy that some of our clients like to do, and this really comes into the more higher net worth arena, is setting up charitable trusts. And there's two different types. There is the charitable lead trust and the charitable remainder trust. So CRT versus CLT. The great way to remember this acronym is lead trust. The charity would get the assets first, and the charitable remainder trust, the charity would get the assets last. And how this initially is set up, the donor can either be alive when they do this, or they can do it at their passing as well. They transfer their the amount that they'd like to give to the trust into the trust. They get a tax deduction immediately in that tax year, and then what happens is an annuity or a guaranteed stream of income is created from that pool of assets. It can be done as an annuity structure. That'd be the CLAT or the CRAT, or you could take it as a fixed percentage of assets as well. That's CLUT or CRUT, and this can be over if it's for the donor, over the donor's life, it can be over their life, or if it's over another beneficiary, it can be over as long as 20 years.
Okay. So you say this is probably more of in kind of a combination of estate planning and charitable giving at the same time. When you say it's really, you're trying to get the money, out of your estate, and then, you can satisfy your beneficiaries will get anything that's left over while the charity gets paid every single year. Or in case of the charitable remainder trust, your beneficiaries would get, a paycheck every month, every year, or a percentage every year. And then anything left over gets given to the charity at the end while we're moving this total amount from your estate, right?
Or if you set it up during your lifetime in the example of the charitable remainder trust, you can get the annuity payment over your life, and then once that's
there you go.
Once you've either passed away or the 20 years is up, the remainder, if anything is left, because that's the caveat. Because when this is created, you use an IRA, an interest factor rate to kind of create the annuity payment.
Right.
Depending upon performance of the market, there could be more assets than what's originally estimated that goes right to the charity, or there could be very little, if nothing at all.
Gotcha. What kind of assets can you put in that? It's just a trust account, right? It's just the trust is created, and then you can, buy stocks, bonds, mutual funds, things like that inside of it.
You can put regular investable assets inside.
Great. Cool. All right. And then last but not least, private foundations. These are separate legal entities generally established by an individual, family, or corporation. These are subject to more stringent tax laws and regulations than public charities and donor advised funds. The reason for that is because they have a lot more administrative control over the assets and where the grants are given. This includes the ability to make grants to organizations other than IRS qualified 501c3 public charities. So if really would want to kind of put this side by side to a donor advised fund, and what are the differences? Donor advised fund, you are limited to gifting to 501c3 public charities, whereas a private foundation, you can really give the money to almost anybody. You can give it to, political super PACs, things like that. So there's a lot less limitations on that front. However, due to that fact, there are more stringent tax laws and regulations, a lot more oversight for private foundations due to the fact that there's more, inherent flexibility after they are set up. Typically, these don't really come into play unless we're talking about vast quantities of money, because there are a lot other, like the ones we talked about before, I'd say simpler methods to gift money away. This is very for, again, very large sums of money to be given over very long periods of time. Andrew, anything you want to add here for private foundations?
I'd say with private foundations, Chris, like you make a very good point. It's really meant to be if you, the donor, want to create a long-lasting legacy and to truly have a meaningful impact, and want your, because boards get set up. You have, it could be a great way to get involve your kids and grandchildren in the future, of, wanting to make sure they're a part of and be such as charitably inclined as you were as well. But there does and it, like you said, it also offers that extra flexibility. With the donor advised fund, as I mentioned, before when you donate that Apple stock per se, it gets liquidated into pools. With the private foundation, you can put the Apple stock inside this specific type of account, and you can keep the Apple stock in there. You can change the investments around. You're not limited to the investment menu. You pretty much have the entire Schwab investment universe at your disposal for our clients that have the private foundation accounts. But there is some extra, I'll call it tax compliance every year that has to be done, as well as the private foundation. There's a minimum requirement of assets. I believe it's around 5% that has to be distributed out every year, or the private foundation would lose its 501c3 status.
Gotcha. Makes sense. I think that might be all we got. If there are any other questions, feel free to call us. We can go through any of these strategies with you guys. Leslie, do you have any other questions come up during the?
No, I think that's it. Thank you, guys.
Great.
Thank you very much. Good information. And please do call Chris or Andrew if you have any questions about what we covered today. Thanks.
Great.
See you,
Thanks,
everybody.
guys.